I'm Duncan McLeod, and this is the TechCentral Show. My guest today is CEO of a company that recently listed on the JSE to great fanfare. Formerly known as Channel VAS, the company was founded in 2012 as a single-country airtime credit provider. It was listed on the main board of the JSE on the 4th of November last year at 19 Rand a share. And that was at the top of the range, and it was oversubscribed several times, giving it a market cap then of 23.5 billion Rand. First Rand took a roughly 20% equity stake pre-IPO, and post-IPO increased that to more than 26%. The platform that this company develops uses AI-driven credit decisioning sold through mobile operators, MTN and Vodacom among them, and financial institutions across 38 countries. It is 120 million plus monthly active users, handles 31 million transactions a day, and makes 1.5 billion credit decisions a month. Microfinancing now generates 72% of its revenue, overtaking the original airtime advance business. So it sounds like a meaty business. My guest to unpack all of this is Salvador Anglada. He is the CEO of the business, which is today known as Optasia. Salvador, welcome to the TechCentral Show. It's good to chat to you. Thank you for your time. And I think a good place to start would be to maybe ask you for a quick explainer of the business. And I thought, let me ask you through the eyes of one of your customers. Maybe walk us through, if you don't mind, a transaction. Someone in Accra in Ghana, for example, who has no bank account and gets a 50 Rand airtime advance or a small loan in under a minute or two. What is actually happening in that time, and who's lending the money and who's carrying the risk?
Okay, that's a good one. So they will, a person like that, he will use their wallet, their phone. They will try to find, for instance, try to look for a loan. He will press the button and see if he's eligible. This is the first thing. Eligible means that we have qualified them for having a loan, and we did that because of the algorithms that are behind and all the data that we handle. If it is the case, he will choose the amount. Could be the limit that we have, could be less. Imagine that he has a limit of $30 and he decided to take a loan of $20. At that point of time, he press, just because he's eligible, he will have that money in his wallet, and all this transaction takes only 30 seconds. And the reason for that is that we analyze the data, his behavior, and we believe he's eligible for take that, and also to pay back that amount maybe in 30 days. The loan, technically, the amount is in his wallet. The loan technically has been given by a partner, a banking partner, whomever it is. Imagine that it is a Standard Bank, for instance, or FNB in Ghana is the one that we call it the lender on record. So that loan is registered in the records of that specific bank. But the company that is underwriting that loan is Optasia, which means that if the loan is being repaid, everything is okay. If the loan is not being repaid and there is a default, we take the cost of that loan on our side and we pay that amount to the banking that we are using as a lender on record. So we use our financial partner as a partner, but they will never get any responsibility related to the loan because everything is on our shoulders.
Okay, so the risk is yours entirely.
This is the big thing about Optasia. We believe and we trust so much on our algorithms, the data that we use. We create a parallel way of, like a parallel credit bureau. We use data that are not in the normal records of the banks. We use more than 5,000 data points, and we create features that allow us to recreate the behavior of that person related to that specific loan. And we trust so much on that data that we are able to underwrite and to take the whole risk of all the amount that we are lending across the different markets that we are operating.
Okay, so it's a pretty robust model that you've developed, and I know AI underpins that, and I want to get into that in our discussion a bit more. But before we get there, what are credit defaults like on your platform? How many of the customers don't actually repay?
Well, it's more about percentage of the amount that is not being repaid. We are lending across the different markets more than $6 billion or we will do that in 2026, $6 billion, and we have a average default rate, and that includes all the services that we provide, that is slightly above 1%. So it's in the level of 1.2%. So that means that out of the $6 billion, we have a default amount at the level of 70 million, more or less, which is the one that we need to absorb as part of our cost. 1.2%, if you compare with other financial institutions that are providing loans, it's really, really low. And that's why, we have a unique model that allowed us to serve the low-end part of the pyramid, what we call the unbanked population, the people that are invisible for the banking system. They don't want to hear about them because they don't have a pay slip, they don't have a pay certificate or a salary certificate, and we are able to do that. The other very important thing is that, yes, we underwrite, we take the default, we take the risk, but we never ask for any collateral. So the risk, the loans are totally unsecure, and this is very important. And the last thing is that if someone is not paying, we are able to extend the amount, the loan, and the period of time. One single time, you get a loan for 30 days, $10. You do not pay, we extend for you another month. But if at that point you are not paying, that's it. We do not blacklist you. We do not go against you. We just take a write-off of that loan, or waiting for you to pay back maybe 6 months later, because some people are back to the platform and they pay later, and that's why our default rate is so low.
Okay, and do you charge an interest rate on this? Is that the revenue model, or is it fee-based?
It's a fee based. That's exactly what it is. It's a fee. We charge a fee on top of the loan, and this is our revenue, that fee, and with that fee, what we need to do is to pay all our partners. This is an ecosystem. We use rails. We use distribution partners. You were mentioning Vodacom or Airtel or MTN. It could be also banks, because sometimes we use the wallets of the banks. Not necessarily need to be a telco, could be even a loyalty program, could be anyone that has customers. They have data that allowed us, we need to access to this data in order to analyze, and also we need to have a way to diverse and collect the money. It could be a wallet, an app, a loyalty program. So those are, we need to pay them, we need to pay the banks, we need to pay the interest rate for the banks, we need to absorb the default, and we need to make a profit out of that, and this is what we're doing with our fee.
Okay. Would you describe yourselves as a software company or a lender? Or something else?
I would say something else. We are an enabler. We are not a software company. Could be more a platform company, I would say, because we have, our own platform. We have our algorithms. We have our intellectual property. Everything is built in-house. At the same time, we are lending, but we are not a proper lender, because the lender is a financial institution. We were mentioning the standard banks of the world or FNB, but we are underwriting that. So we are a different thing. We are a platform that is able to take risk on the lending, and we are able to expand the financial inclusion across the countries that they don't have access or easy access to financial services.
Let's talk about the AI algorithms and platform that really powers this system. Can you maybe give us a bit of technical color as to how that system works, how you built it? You make 1.5 billion credit decisions a month for people who are basically invisible to credit bureaus. What data are you actually reading, and what's your bad debt rate telling you about whether the models work?
Well, the whole thing is to build models that allow us to understand the behavior of the people when we don't know the people and we don't have physical proofs of their income. This is what exactly it is. And to do that, we collect data from different sources, and we collect data from the airtime usage, for instance, from mobile operators, or transactions that they do in their wallets. We also understand more behavioral habits. At what time are you getting your income? If it's regular, it's not regular, how you are spending that. There are a lot of factors that allow us to try to recreate or understand if this person have a regular income or not, or how much income they have, and even the source of that specific income. This is what we try to get out of all these unstructured data. By doing that, we train the algorithms, and those algorithms will allow us to know normally two things. Your propensity to default or not default, but also the amount that you can get in order not to default. Because at the end, it's not about yes or no; it's about how much. And this is what we do, and we do it in real time. At the time that you are asking for a loan or you use your platform, at that specific time, the algorithm works in a way that give it a specific amount for you, which is different to the other 130 million people. So it's a unique, personalized algorithm that it gives, this indication. This model is a live model. It grows, it learns itself. Every single time that there is a transaction, there is a learning out of that. We have different models for the different places that we operate out of more than 38 countries, 60 different partners. So there is a learning curve. There is a flywheel effect that allowed us to every single time that we provide a loan, there is a learning process. Every single time that we do that, sometimes there is a new variable that we include in the algorithm. There is a reinforcement learning process that allowed to do so. So the models is not a specific, it's not something that happens today. It's something that has started already 10 years ago. And this whole history is the one that is allowing us to improve every single time and to manage the growth that we are having while we keep the default under control. And there is this effect. And those models, as I said, are tailor-made for each of the markets. Not every market is different. Not the variables for every market is different. We operate in Nigeria, South Africa, or Ghana, or even Pakistan. And even if maybe the base of a model is the same, 50-60%, there is a tailor-made factor that is unique for each of the markets that we operate.
Mm-hmm. Which has been your most successful market and why?
Well, we don't have any. I think we have a very successful markets in Asia. Pakistan is a very successful market. Indonesia, exactly the same. Ghana is a very good market for us. South Africa, it is a good market, not for microfinance, but for airtime credit solutions. No, the markets are successful. To be honest, as bigger as the market, as better, because you have more users, and that allowed us even to train better the markets. South Africa have 65 million, 70 million people. Pakistan, 200 million people. Nigeria is another very successful market, 250 million people. So yes, I would say the bigger the better, because the amount of data allowed us to fine-tune better the algorithms that we are using.
Have you gone into the Indian market at all? If not, why not?
Well, India is not a market; it's a continent, no? And I think it's 1.5 billion people. And it's all different geographies. It's a market that is very regulated. It's not easy to go there with a foreign company. And today, it's a market that is in our scope, but we have so many things to do. We are operating in so many markets. We are trying also to enter in markets today like Ethiopia or Egypt, that honestly we need to be very careful not to defocus on what we're doing. So it's a market for the future. It's not a market that we can afford today, because maybe we would not do other things that we want to do.
Okay. I want to come back to what you said about South Africa. You said this market has been successful for you from an airtime perspective, but not so much for the rest of the business. What's the reason for that? Is that because South Africa has a fairly well-developed financial services sector, or is something else at play?
No, you're right. South Africa is a very bank market. The population, 90% of the population have a bank account. Although, you know that it's a very still cash market. People take their salary in the bank and then they take it out and get the cash. But the reality is that the bank system is quite well developed, and you have very strong players in the market. First, second. For that reason, some of the rails that have been developed in other markets are not so popular in South Africa. The mobile money is not as popular as other markets. If you look at MTN, for instance, does not have too many wallets in the market. Is not so used, and this is a rail that we like to use. Third, there are players in the banking side that they have been able to be successful also on the low end part of the pyramid, providing loans to some of these people. So this is those are characteristics of South Africa. But having said that, of course, we are going to try. There are very good initiatives that now we are playing off, also in partnership with some of the banks that exist in the market, and we believe there is a space to develop this specific market, and most probably you will see us also enabling some of the actors in the market to provide loans also to this part of the population that are not properly banked. Maybe they are banked, but not properly banked, or at least they are not taking, or they have not the opportunity to get a loan from the banking system.
Okay. And how big do you think that market is here?
Well, I think it's not bad. I mean, I think we think about maybe you have 15, 20 million people that they are not having proper access to loans or financial loans from the traditional banking system. And it's not small. Of course, it's not as big as Nigeria or Ethiopia. Maybe you're talking there about 40, 50, 60, 100 million people. But it's not a small market. And I think it deserves also to be developed. And this is what we would like to do.
Mm. Tell me about your relationship with FirstRand. They own 26.1% of you the last time I checked. What was the strategic rationale for FirstRand buying such a big stake in Optasia, and how do you work with them on a day-to-day basis?
Well, the strategic rationale, you need to ask them, I mean, because they are the ones that did the investment, but I can talk about, the relationship that we have. I believe there are different streams. We are working on different areas of collaboration, from potentially engaging them with the credit scoring capabilities in market that they may have a wallet. They are trying to serve the market on the low end part of the pyramid, towards being our banking partner and our lender on record on some of the markets that we are operating, or thinking together about potential new services that we can launch in different markets. So there are different areas of collaboration. I believe for them is also a learning interesting curve to look at other type of partners with different technology, digital driven, digital native, that could potentially enhance and improve all the services that we are providing. And I believe it's a fantastic bank. It's very dynamic. It's very innovative, and I believe this is why they are exploring other ways to be competitive in the markets that they are operating.
I know you've been asked this next question before, but apologies, I'm going to ask it again. You listed on the JSE. Many African tech companies look at Europe or North America to raise capital, London or New York or elsewhere. You chose Johannesburg, and I think you described it as the natural choice as a place to list. Maybe just take us quickly through why you decided to list in Johannesburg and not, for example, go to the London Stock Exchange.
Well, that was an option, to be honest, and we evaluate all the options, and one of them was also Europe and London. But I believe it was a process. We approached this asking investors, asking them what is the best option. Of course, we are operating in Africa. We are an African company. We have 20% of our business in South Africa, but that was not the only reason. It was one of the reasons, but the second one was, what if we list ourselves in South Africa? And we have such a big support from investors, not only from South Africa, of course, but outside South Africa, that it was a clear choice. If you operate there, if you have such a lot of business there, if you have such a good stock exchange like a GSE, why you would not list your company over there? And that was the main reason for that. Also, it was important to have enough liquidity, be big enough, have a free float above 30%, and all this was part of the conditions that we put it in place in order to have a successful IPO. So natural choice, but also very well supported by our future investors.
Great. I know you ran into some trouble in Nigeria in recent months. I think you were suspended, or your airtime credit business was suspended in Nigeria for a period of several weeks over a lending regulation dispute. What exactly happened in that market, and what did it cost you, and what did it teach you about regulatory risk?
Well, first of all, we know about our risks. We are operating in 38 countries, and that's why one of the big KPIs that we have is diversification and trying not to have any market with the weight in terms of revenue above 15%. And this is the case. In the past, we had more business, for instance, concentrated in Nigeria. Today is around 13 to 14%. So knowing the risk, and the risk is coming because of the currency, but also the risk could come because of whatever regulatory situation. So the most important thing that when it happens, we are ready to absorb that. And one of the output of that recently, we confirm our guidance for the market, even with the situation in Nigeria. Second, the problem it's more a disputing between two regulatory bodies, the anti-competition and consumer protection from one side, and the telecommunication regulator. And it was about the definition of our product. Airtime credit is a lending product or it's a telecom product, and this is the dispute that happened. There is one regulator that decided that it was a lending product, and just because of that, there were some conditions that need to be taken into consideration in order to provide the service, and that's why it was temporarily suspended because of that. After that, the clarification happens, the conversation happens, the service was being launched again after several weeks, as you just mentioned, and now we are in the process to try to define all this properly and to try to keep the service with the right rails and the right regulatory conditions. So it was a little bit aggressive, the suspension, I would say, because it could have been sorted out without that suspension. But at least, now it has happened that, the conversations are happening. I'm sure that in the future, we'll have a more stable situation from a regulatory point of view, and the service will continue being provided across the Nigerian market.
Okay, yeah, I think many South African companies that have invested in Nigeria know about the regulators in that market. They can be quite tough. You've said that Optasia is an African company first. 60%, I think, of your market is here, and your growth is expected to come from the continent. Most of your growth is expected to come from the continent in the coming years. You're reporting your next set of financial results, I think in September, where you've guided revenue up by more than 50%. Where do you see this business, Salvador, going in the next few years? Maybe paint the picture for 2030. How many users, which markets, and what's your what are the products that are going to drive your growth in that period?
Now, definitely, we have 130 million, 30 million active users monthly. And the expectation is to continue growing that figure in the coming years. We have, I think, three areas of growth, I would say. First of all, the existing markets, because we continue growing in terms of number of users that are taking the service, but also the denomination, the amount they got as a credit. The economies are growing. The confidence on us to them is higher, and you can see that the existing markets continue giving us very good growth. The second area of growth for us is the new markets. Even if we are in 38 markets, we are not in Africa. We are only 22 markets, and not in all of them we have microfinance services. And you just mentioned South Africa, for instance, but there are others that we are not. So we are really pushing to have microfinance solution in other markets, and we are pushing to enter in markets like Ethiopia or Egypt or Mozambique that we don't have that services as we speak. Entering a new market is the second area of growth. Also take into account that you have 400 million wallets in Africa, and you have in the world more than 1.3 billion people that are unbanked. So the potential of the market is there, and we would like to take that space. The last one, very important for us, are new products that does not exist today. We are very focused, for instance, on providing service to merchants, small and medium businesses. This is not well solved by the traditional financial system. We are looking at buy now, pay later, for instance, services that is quite popular in South Africa, but it's not being extended across the other countries. And when you see e-commerce and digital commerce being expanded, I mean, we can plug in very well and nicely with this type of solutions. Or we are looking for more innovative service like what we call virtual credit card or line of credit, which is, I mean, working like a credit card type of credit that you can pay back in 30 days, but you can use it during these 30 days as much as you want. Those are examples of services that we are launching, that we're trying, that we're testing, and that could allow us to launch in all the markets that we are operating as we speak.
Mm-hmm. And will you remain exclusively focused on emerging markets, or do you think there's an opportunity at some point down the line to launch products in developed markets as well?
I don't think so. I believe we are very focused in emerging markets, in unbanked population, in places that, I mean, the digital rails has been deployed. We're looking at Africa. We are looking at Asia, which is also very important. And maybe at one point of time, we will look at India or Latin America. We are not doing that as we speak because we don't have bandwidth to run this. But of course, at one point of time, could be also our another destiny for our service.
Very big markets there that you're looking at. Ethiopia, of course, is one of the most populous countries in Africa, and potentially a huge opportunity given the banking rate there.
Quite impressive what is happening in Ethiopia. I agree with you. It's a very interesting market, and it's a market that we have put the focus on as we speak here.
Great. Well, I look forward to seeing how this business develops in the coming years. I'll keep keeping a close eye on your financial results as you report every 6 months. Salvador Anglada is CEO of Optasia. Thank you so much for speaking to the TechCentral audience today. It's much appreciated.
Thank you very much, Duncan. It was a pleasure. Thank you very much.